Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show.
Hey everybody, welcome to another episode of DIY Wealth Canada podcast. Bob, along with me, is my co-host Nelson. Today we're going to talk a little bit about why we do DIY investing rather than using a professional or professionals and some of the pros and cons of DIY investing. So, when you really think about investing, there are many ways to do investing, right? So you could do it with robo-advisor that has become quite popular over the last decade, I would say. Going earlier, mutual funds used to be pretty popular in Canada, right? That has still, mutual funds are still around, but more and more people have shifted to ETFs, and obviously there's financial advisors that use your financial advisor to invest. They make decisions for you based on your answers on questionnaires and stuff like that. Right. So we want to talk about why both Nelson and I do DIY investing and kind of our path getting here where we are today. And again, just I think we're kind of free-forming a little bit and just discuss the reason. So Nelson, what do you think?
I want to start off with we're going to talk about fees, obviously. Fees are a big reason why people go the DIY route. And there'll be enough talk about that later. But I want to talk about probably the most important reason that I DIY. And it comes down to, kind of really two things. One is the independence of knowing that I can navigate the financial world and that I don't need to rely on anybody for help. And two is that the game of finance is fascinating. I love finance so much because there are so many different ways to end up ahead. There are so many interesting people that you can listen to or read or whatever. And it's this game with so many possible solutions that all you really need to do is figure out your own solution out of the many different ways to do it. And that's the beauty of finance, is that it is just so individual that you can just take something and you can make it your own and you can just have, so much fun with it. I love researching stocks. I love reading about these things. I could, annual reports are great. I just dive in. It's fantastic. And I know that not a lot of people would agree with me in terms of that, but that's the beauty of it. It's just you find your way to do it, and it's a perfectly valid way. A lot of times, anyway. Sometimes, there are some very distinct disadvantages to doing it, but that's the beauty of finance, I think. It's a game with so many possible solutions that you get to, it's always interesting. And it's always going to be fascinating to me.
Yeah, and I think personal finance is very personal, and that's why, I try to stay away from these arguments or discussions on social media because it's so once, like, people just argue their point and nobody gets me in the middle. You talk about, you can see like people say, oh, dividend investing is great, and some people say dividend investing is stupid, and index and vice versa, right? It ultimately comes down to your own preference. I think I mentioned this before. It's kind of like asking somebody what's your favorite food. Everybody's going to have a different answer, and depending on your mood and how you feel, you may want to eat Italian today. Tomorrow you might want to eat something else and don't want to eat Italian or pasta or pizza, right? So I think it's just based on your situation. I think we're going a little bit off tangent here. Just bring it back a little bit in terms of DIY investing. Personally, for me, I started with mutual funds. I was, when I started working, I kind of touched a little bit on individual stocks like quite frankly, I didn't know what I was doing. I was just following these hot tips and lost a bunch of monies and things like that. But I was actively participating in my work's RSP, and those funds I could only buy mutual funds, right? And then I got into work also has you could buy additional mutual funds with additional money. So I enrolled in that. I think you know how mutual funds are. You look at their performance record and you're like, oh, I can't lose any money. This is like a guarantee win. And I mean, that's how naive I was, but I wasn't really looking into the fees. And over time, I started realizing, it's charging 3% fee, and it's regardless whether the funds are making money or losing money, you're getting dinged either way. So that adds up pretty quickly if you calculate it. And as I learn more and more about personal finance, it's just the idea of managing my own money makes a lot of sense. And ultimately, you should have the most interest with your money rather than somebody else, right? So really take care of yourself, know what you invest in. Yeah, mutual funds. I think the MERs have come down in fees a little bit nowadays, but it's still relatively high to ETFs. And I think with these all-in-one ETFs nowadays, with Vanguard and iShares, Horizon, even TD and BMO, they all have these all-in-one ETFs. It's becoming extremely easy to manage your own funds. Now, I did mention robo-advisor has been very popular. I think people still use robo-advisor, but I haven't had any experience on robo-advisor. I think, Nelson, you probably don't either. Do you know anybody that uses robo-advisor?
Yeah, I don't have any experience personally, but I do know at least one couple that uses it anyway, because I was asking them about it just a few weeks ago, actually. They have so they're not using the biggest one in Canada is Wealthsimple. Of course, they're not using Wealthsimple. They're using one that comes from one of the big five banks. And, so I asked them, like, hey, what do you think about this product? And they said it's really quite good. And, like the kind of the comparison that they gave me was that they're getting sort of 90 to 95% of what a financial advisor is offering them at a fraction of the fees. And so, of course, for those of you who aren't familiar, the robo-advisor charges you a small fee on top of the fees that the ETFs, the underlying ETF that it holds. And in exchange for that, basically, you get, everything from rebalancing to this one offers some tax loss harvesting ability where, if a fund is down, it will sell that fund and then sell or buy a similar fund, allowing the clients to do some tax loss harvesting and kind of save some money on taxes that way. But that hasn't really been that important of a feature in the last few years because the shares of everything have just gone up and up and up, so it's not really that important to them. But ultimately, it's that, like I said, for them, it's just kind of this 90 to 95% of what an advisor offers, and they do have the option to talk to someone whenever they want, but they really feel like they don't need to talk to anyone because the software does what they want the advisor to do at the end of the day. And are these clients, maybe a little more sophisticated where they don't freak out when the market downturn or anything like that? Maybe not. Like, we don't get that far into it. But ultimately, yeah, I think that a robo-advisor is a fantastic thing for, the DIY investor who wants that kind of financial advisor light kind of relationship. And a lot of DIY advisors really have a distrust of the financial industry, in terms of fees, just in terms of kind of the whole thing. And that's sort of the reason why they go the DIY route to begin with. So it's kind of a middle ground for these guys where it's like, you do get a little bit of help if needed, but for the most part, it's just kind of all automated. So, I think it's a nice kind of middle ground for people. The only disadvantage I'd say is that when you're just starting out, you only have a little bit of money. Robo-advisor, the fees are, they're a little bit on the high side. The fees come down as you have more assets under management. And that's unfortunately bad for the DIY investor that's just starting out.
Yeah, so robo-advisor, obviously the financial institutions typically offer those. There's also passive. It's like a tool that automate and simplify your portfolio rebalancing in particularly. So you could, if you're doing, individual ETFs, kind of, Canadian, international, developed country, et cetera, bonds, and you have a certain percentage for each ETF, then you could utilize passive and that would auto balance for you. I know Wealthsimple now has like a free, like a tax loss automatic harvesting thing that it's a little bit like robo-advisor. I think ultimately it just depends on how involved you want to be on your day-to-day or month-to-month portfolio, right? Like how much do you want to touch your portfolio? How involved you want to be with your portfolio? So I think robo-advisor has a place there. And advisors, like we never really use an advisor. The advisors, financial advisors I've seen were the people that worked in these financial institutions, and really they were, I almost call them salespeople. They were trying to sell me the mutual funds that these financial institutions have, and typically these mutual funds are again a little bit higher in fees, right? So I didn't feel like I was getting the full experience of a true financial advisor. The way I see it now with financial advisors is that they're not just offering advice in terms of what to invest, because I think nowadays most advisors, I'm kind of generalizing here, obviously may not be true for everybody. I think most financial advisors would go down the all-in-one ETF route typically. But where I see value of these advisors is like, estate planning, tax planning, sounding more sophisticated stuff. And quite frankly, maybe not everybody needs this kind of planning, right? If you're a high net worth or if you're high income individual or couple, maybe that's more beneficial. So yeah, I think that's where DIY works for us. And I'm not saying that just because we do DIY investing, we don't consult professionals. I definitely have talked to tax specialists and people, and some of them have financial advisor background, right? So I think it's okay to pay a fee to get professional advice. Just I don't know if there's a value, at least for us, paying 1 or 2% of management fee each year, knowing that I could do 80-90% of that stuff myself. Nelson, is that kind of what you're thinking as well?
Yeah, absolutely. When it comes to, they say that there's no free lunch in finance, and I would argue that there are easy free lunches in terms of finance. And one of the easiest ones out there is just for individual investors to decrease the fees that they pay. And the easiest way to do that is if you're working with a financial advisor and that financial advisor has you in a portfolio that they charge a fee on top of that portfolio. You got to look at ways to get that down. And ultimately, it's like, if your portfolio is expected to return, say, 8 to 9% before inflation over time, and fees are in that 1 to 2% range, but it seems like on the surface, well, fees are reasonable, just 1 or 2%, but no, like that fee is between 10 to 20% of your expected returns over time, and is a really tough pill to swallow. And it's just the easiest way to increase your returns over the long term. And Bob, like you said, the in terms of what you should invest in, one is that's like kind of an individual thing for every person, depending on risk tolerance, et cetera. But two, it's like, I kind of agree with you where it's like, this is mostly a solved problem. There are excellent iShares, Vanguard, all-in-one ETFs, balanced ETFs where, it's like a 70% equity, 30% bond just in one ETF. or 100% equities in terms of like XEQT or VEQT. There are just so many resources out there that will the average investor just a really simple, easy way to invest that does 90 to 95% of the work that a financial advisor does. In terms of paying for specific advice, I'm with you. I think that you really nailed it, where it's like, the advisor model, I think, needs to pivot into something where, I'm happy to pay for advanced tax advice. Although if I was going to pay for advanced tax advice, I'd use a accountant rather than an advisor. I'm happy to pay for, kind of advanced estate planning advice, these sorts of things. If I were to make things complicated and, put money into a corporation and then look at the most tax effective ways to draw that money from that corporation, by all means, pay for experts to help you out with that. But, do it on a per hour basis or a la carte basis. I think you save just so much money over the long term, especially if you're, into the position where you're at worth, and like it's these fees or these services are included in a 1% to 2% fee. It's just like that's a lot of money to pay for those services, and you're probably better off doing so as needed.
Yeah, and then something for me, I know at least with Works RSP, I guess a lot of people have probably gone through. You've probably gone through this as well, Nelson. Is like when you create an account, they typically you have to fill out a bunch of questions, right? It's standard questions like, oh, how would you feel if you have a potential, I think, returning 30%, but with a possibility of losing 10% of your portfolio, and there's like different options, right? And you kind of have to like fill out, answer these questions, or like, are you a long-term investor, or the way I see it is when you're filling out these questions and you're answering them, it's really tough because you almost, I don't know, at least for me, I always feel like I answer more on the aggressive side, and or sometimes I may answer it on the conservative side. It just depends on how I feel, and you don't get a true sense of what you would, or how you would react when there's a bear market, or when the market drops 10-15%. It's easy to think what it would happen to you, but in reality, your reaction might be completely different. And if you're based your investment on these answers from the questions, you may not get an accurate portfolio that reflect your risk level. And with DIY investing, I feel like you're able to change your investment a little bit quicker than using an advisor. Maybe that's not true with some of these advisors out there or robo-advising. So you could maybe react a little bit quicker. On the flip side, it's also good when you could react too quickly, because then you could potentially ruin your portfolio pretty quickly here. So yeah, there are definitely pros and cons. And ultimately, I think with DIY, the reason why I think DIY is so much easier now than say 10, 20 years ago is there's so many different products available out there. We talk about the all-in-ones. Those ETFs are excellent ETFs for somebody that don't really want to do much when it comes to investing and just kind of on autopilot. I would highly recommend those all-in-one ETFs, right? And then you just need to figure out what makes sense. Is 100% in equities, 80-20, 60-40, you name it, right? And you could change that relatively quickly, and couple with the no commission trading a lot of these financial institutions are offering, you could really build up your portfolio over time, paying very, very little fees. These all-in-one fees, I think, Nelson, they're like 0.2%, 0.25%. Like that's nothing compared to, I mean, when I started like really getting serious investing, I think some of the mutual funds were like 3-4. I've seen 5% mutual funds. Like the amount of money you're paying per year is just absolutely mind-boggling in comparison, right? So, and this makes a lot of sense in DIY. And Nelson, like you said, if you need advice, talk to the professionals. I think hourly fee-based professional makes so much more sense than paying certain percentage of your portfolio each year. Obviously, as your portfolio gets bigger and bigger, you're paying more dollar-wise. Now, on the flip side, some people think advisors are great, and there's definitely a place for advisors. Don't get me wrong. It's just very personal dependent. Again, for us, we just think DIY makes sense.
Yeah, Bob, you talked about the risk tolerance surveys that you fill out at work, and I would always just go balls to the wall, 100% equities. Like, you have financial education, you can kind of figure out what these tests are trying to get you to do, and you can kind of game them depending on sort of what your long-term goals. But I think that ultimately about a bear market or whatever, and I think it's a little bit like sex, where you don't actually know what it feels like until you experience it. So some people, the stocks are down 20% in the bear market, and who cares? But I think a lot of people, much more than what will admit it kind of publicly, is that they freak out, and they should not be a portfolio that is 100% equities at any point, if that's what their kind of thinking is. And I remember in March 2020, someone phoning me and was just freaking out. The market was down, and should I sell everything? And I told her, it was like, no, absolutely do not sell everything. Buy if you can, it will come back. But also, like, think about what you're feeling now and look at maybe de-risking your portfolio in the future, because she was freaking out, and that kind of concerned me. And anyway, she wrote it back up like it was a happy ending, but it's an important thing for her to figure out. But let me kind of pivot a little bit to, Bob, you said about kind of these hourly rates for professionals, and I think that that's an excellent thing. But I want to kind of talk about something that I just kind of grinds my gears in terms of the financial advice industry has pivoted from, maybe not pivoted, because most financial advisors are still kind of asset under management, pay a yearly fee, but these are the fee only financial planners. And so these are financial planners that you pay the set fee, and they basically look at your life and kind of just ways to make things easier, to optimize taxes, whatever. And my problem is not with the model. I think the model in theory is great. My problem with it is that, well, these financial plans cost anywhere from like $2,000 on the low end, like $10,000 on the high end, and the people who need this advice the most simply can't pay for it. And it's just like, in general, why I think the DIY aspect of investing is so important, and why I think it's such a massive positive for DIY investors to sort of get together and learn from each other about these things, because it's just fees, and this is supposed to be the low are these fee only advisors, but they're just like, it's hard to get behind an industry that just charges so much money for, like, advisors are charging their time out at like $200, $300, $100 an hour, and I don't think that meshes well with the stated goal of trying to help people.
Yeah, I think it's very cost prohibitive, especially when you're starting out. And you're absolutely correct, Nelson. It's very discouraging when you're just starting out and you're looking for advice, and it's like, oh, it's $1,000, $2,000, $10,000, and your portfolio is tiny, and you're just like, well, why? What's the point, right? So absolutely, I think that's extremely difficult, and that's where maybe when you talk to these advisors, they're kind of bashing you and me, Nelson. Like, oh, we don't have any credential and we don't have any credibility. Like, we're just, in a way, we're kind of thin influencers, maybe we're doing a little bit better than some of these bad apples, I would say. But I mean, ultimately, we're here to kind of share our experience and what we have learned over the years. And we have definitely made our shares of mistakes, and we have made some good bets, right? And you're gonna make mistakes throughout your investing journey. There's no way you will get 100% of your decision right all the time. You're gonna make mistakes. And Nelson, you talk about the whole losing money and your decision. Like, it's so difficult when you're just answering questions on paper, or you're trading paper money. It's definitely different than when you are investing with your hard-earned money, right? I think the goal here is being able to invest and grow your portfolio in such a way you could still sleep well at night. You're not waking up in cold sweat, worrying about losing, whatever amount of money you have, right? Like, for example, COVID. Like, I think our portfolio at some point was down $250,000 on paper, and I still slept like a baby, because I was like, well, there's not much I could do. It's outside my control, and I know the investments that we hold are sound. They're just being suppressed by macro event or global event, a pretty significant global event. So I didn't do anything, but I certainly knew people, or I heard people that sold at low point in the market because they couldn't sleep anymore. Right? They were freaking out about losing money. So ultimately, it's you need to understand that how you react during a bull market or a bear market, and there are people that, like, they have to trade, or their hands get itchy, which I just like don't understand why, but that's how some people react. And if you're like that and you feel like you have to trade regardless, you need to put methods to kind of prevent you from ruining your portfolio because you want to frequently trade. And yeah, whether it's advisor or robo advisor or such, or DIY, I think ultimately you need to find something that works for you. And there's no problem switching back and forth, right? Like, you could have started with DIY and then switch to an advisor because you may find DIY takes too much of your time and you want to professionally handle your portfolio. That's perfectly fine. Or the other way, right? There's no one path to invest. Like, there are multiple paths.
Yeah, ironically, the person you talk about who trades too much, they would be well served by having an advisor. Typically, there are some very successful, skilled traders out there, but they are very much in the minority. It's a little bit like, all the golfers in the world versus professional golfers. Yeah, there are some very good golfers in the world, but most, including me, suck. And so anyway, that person would benefit from having an advisor, but they probably don't have the personality type in order to hand everything over to an advisor and take that hands-off role. They just can't do it. They feel that need to trade and to be active and to be doing something, even though we both know that oftentimes the best thing to do with your portfolio is nothing. But there's a wonderful quote that just every now and again I think about it. When you were talking, I thought about it again, by the Morgan Housel, the personal finance writer. You all know him. He's very famous. And I'm not going to get the quote exactly right, so I apologize. But the quote is basically that, the most successful investors are ones that are able to put up pretty good returns over very long periods of time, because they have a system that works for them, that isn't going to work in every kind of market. Sometimes tech stocks do better, sometimes Bitcoin does better, sometimes the boring dividend stocks do better, and sometimes precious metals go crazy, and everything eventually gets its day in the sun. But consistent investors are the ones that do best, because they just stick with a plan, they have a good savings rate, and they just sort of slowly put money aside and let the miracle of compounding do its thing. And financial advisors hate those guys because they have no need for an advisor except for those specialized services that we talked about earlier. So I would just say that in terms of of a DIY approach, I don't think it gets much better than that. Just kind of quietly do your thing over time, and it'll work out. Yeah.
Yeah, I think I may have mentioned this before on another episode, but maybe I haven't, or maybe I wrote about it on my blog. I came across this idea. I think it's in a book somewhere. I can't remember the name of the book. Obviously, I read quite a bit, so I kind of they'll pick out things here and there. I don't remember the book's name, but something about how investing, everybody's talking about beating the index, right? That's the ultimate goal. Is like, I want to beat the index. I don't want to be the average, and that's if you think about it, some people are going to be the index, some people are going to lose to the index, and that was kind of the reason for buying the index. So you're just tracking the market minus the fees, which is fine for some people, right? So when the market is doing well, you're doing well. When the market is doing poorly, you're also doing poorly, but you're tracking the market. The idea in this book I came across is not about beating the market anymore. It's about meeting your financial goals. So who cares if you're returning 10%, 15%, 20%, or negative 5%, negative 10% year to year? It's about being able to reach your financial goals. So if one of your financial goals is to, being able to be financially independent by age 45, as long as you reach that goal, does it really matter if your portfolio is beating market or not? Or if your goal is to be able to pass down certain amount of money to your kids or your grandkids, does it really matter if your portfolio is returning 20% each year versus 5% each year? So that kind of changed how I see things a little bit, such that it's cool to be the index every year kind of thing, but it's like, well, do I really need to do that? Or is it better that I could make sure my investment portfolio could sustain our expenses such that we could hit financial independence early enough so we have more options in life? So that's an interesting idea that I came across. I thought I would share with everybody.
One of the advantages to dividend investing is that it makes the withdrawal problem really easy. You just spend your dividends. Companies send you money and you spend them. And, when I was doing the early retirement thing, I was spending most of my dividends and then I would reinvest some. And now, of course, I reinvest many, basically all of them now because I work now and, like I have that. But, for some people, that is a big advantage, is that, hey, the dividends, I can spend the dividends. Awesome. Perfect. That is. And for other people, that's a big advantage because they've crunched the number. They have some sort of edge when it comes to withdrawal strategy, or they would rather, have more flexibility when it comes to their withdrawal strategy. And therefore, they want to sell shares to pay for their retirement. And ultimately, this just comes down to that everybody is different. That's the beauty of DIY investing, is that you can figure out, hey, I prefer this method. I prefer this method because, it helps me hit my goals. And Bob, like, that is whichever book that's from. I know Dividend Growth Investor is big on kind of that one piece of advice. Him and I have talked about it many times, where it's like the important part is hitting your goals. And I let you, talked about right at the beginning of the show, like, it gives you that independence. You can forge your own path and you can say, hey, this is what I choose to do because it's best for me. And a financial advisor or, a robo-advisor even may not do that. It's going to, kind of view the accepted financial theory, which is obviously has some merit it just may not have merit for you.
Yeah, so I think we're up against time. I think this episode is a little bit shorter than usual, but yeah, I think there, whether you use advisor to manage your portfolio or you DIY investing, I think it just comes down to your personal preference, your choice, and whether you want to spend time analyzing or managing your portfolio versus having somebody else to do it. And again, like Nelson said, robo advisor is kind of in the middle. So you could go one end of the spectrum to the other end, right? So you could have financial advisor who does everything for you and you don't even need to look at your investment. And they're advisor that get you more involved. So you could pick the advisor method if you're like super busy and you just kind of want to review here and there. That's totally fine. If it works for you, go for it. And if you're more comfortable with like lower fee robo advisor where everything is automated and you can still talk to a person if you need to, yeah, that's totally fine too. Now, if you want to do more management on your own, want to learn more about, these, how investment works and things like that, I think DIY is a great way to do things. And it also gives you a little bit more talking points when you talk to other people and I don't know, I find myself get more exposed to different ideas because I'm managing our own portfolio. We're doing DIY and, I come across ideas or we talk to friends and people we meet and, you're exposed to ideas and you're like, oh, that's interesting. Let's explore a little bit more. So that from that perspective, it's been quite interesting for me. Nelson, any last thing to add before we wrap it up?
I'll just say just how much easier to be a DIY investor versus 25 years ago when I got started down this path. You have the internet. There are so many good resources out there. Yes, there are some bad resources. And, there are people who are sharing their journey who, maybe aren't doing things that I would agree with anyway. But the point is that like there are so many people and there's so many resources out there that I think just about anybody who wants to put in the effort can learn about these things. And, there are just tons of creators that share that. And ultimately that is a good thing for the average investor because it makes the space, I think, more competitive, which brings costs down. And ultimately that is the closest thing to a free lunch we get in finance. So kudos to everyone. And, we got to include ourselves in here, obviously, the DIY Wealth Canada podcast for doing this and just getting this formerly taboo subject out in the open.
Yeah. All right. Let's wrap this episode up. Thanks again, Nelson, for another interesting chat. And I hope everybody enjoys this episode. And if you have any comments or such, feel free to leave us a comment either in the episode comment section or you could leave comments on YouTube. We do read these comments. We may not always reply to the comments, or you could reach out to us on our blogs or even on Twitter. So yeah, let us know. We would love to hear your feedback. All right. Thanks again, Nelson. Let's talk again next time.
Sounds good. Thanks.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Tawcan or CDI Newsletter. Thanks. See you next time.